Welcome to the CIM MES discussion group, perspectives and insights on mines, metals and mines, which we run a few times a year. And the CIM MES discussion group has other sessions as well. Today's guest is Jeffrey Christian from New York, managing partner of CPM Group. Our title is Gold and Silver Landscape, is it changing? Not. And we have the insights with respect to gold. Also, we'll discuss silver, platinum markets if we have time, and I'm sure he will be able to talk about the highlights from for that industry. Jeffrey Christian is the managing partner of CPM Group based in New York. He's considered to be one of the most knowledgeable experts on precious metal markets, commodities in general, and financial engineering using options for hedging and investing purposes. He's the author of The Commodities Rising, The Reality Behind the Hype, and How to Really Profit in the Commodities Market, that was published in 2006. He's been active in the industry since the 1970s, and he has expertise in a range of commodity markets, including precious metals, energy, base metals, and agriculture. Jeff Christian will discuss the current and future fundamentals today at gold and silver markets, including mine production costs, fabrication and investment, expansion of global refining capacity at different geographic locations, and trends of central bank buying and selling of gold. He will contrast these realities to the marketing hype and suppositions rampant in the precious metal markets. He also will discuss prices and the reasons, either good or bad, doesn't matter, for the large spreads between wholesale prices like Comex and London spot and retail prices for smaller precious metal investments. If there is any significant merit for the producers to strategize for these opportune spreads, which may exist for the producers more than the retail investors, I would say. Canadian Institute of Mining and Metallurgy and Petroleum is a nonprofit technical society of professionals in the Canadian minerals, metals, materials, and energy industries with 11 technical societies and more than 30 local branches across Canada and overseas. CIM's vision is to be the trusted authority and collective source of advancing mineral industry knowledge, guidelines, and the best practices. CIM's mission is to cultivate knowledge, best practices, and innovation to support our members, improve awareness of the minerals industry and society, and evolve industry responsibly. The Institute was incorporated in 1898 by an Act of Parliament in Canada as the Canadian Mining Institute in 1920, became the Canadian Institute of Mining and Metallurgy, and in 1990, became the Canadian Institute of Mining, Metallurgy, and Petroleum. And the Management and Economic Society of CIM, abbreviation MES, who Carlos chairs as an active member for many years. It works towards furthering education in mineral economics. It uses the funds that we have. It raises the support to various educational initiatives and programs in mineral economics at Canadian universities. In addition to members involved in the economics and management in mining, CIM MES has expanded to encompass members involved in all aspects of the management of companies active in the mining and petroleum sectors. CIM MES sponsors various events throughout the year across Canada and internationally, which we had a Hong Kong chapter some years back, still have it, that provide industry professionals with the opportunity to share experiences, insights, and ideas on topics relating to the economics, management, and financial aspects of the business. This is the CIM part, MES part, and I introduce Jeffrey to you now. Our sponsors for this particular event, I Am Gold. They've been sponsoring this series for a long time. We appreciate their sponsorship and their consideration. Just one other thing before we start. Any questions you have, please put into the chat, and we will deal with that at the end of the presentation. And the Jeffrey presentation, he got over 70 slides. He's great. He's been doing this for years. Just had a silver session yesterday, wide attendance for his guests and for his clients. And it was fantastic, by the way. And he does this quite often. He's very generous with the information. And we appreciate him being here for CIM. Thank you, Jeff. Your turn.
Thank you, Terry. I've known Terry for a long time, and I'm glad to be here. Let me just make sure that I can do whatever it is that I'm supposed to be doing. Hopefully you're seeing my presentation.
Yes,
Terry has asked me to talk about a lot of stuff today. He asked about, can you talk about gold supply and demand and prices and where they're going? And then what about silver? He added platinum group metals in the introduction. He also wanted me to talk about refining and some of the issues related to the expanding number of precious metals refiners around the world and fingerprinting of gold and things like that. And then he asked me to talk about some of the errors and omissions, the marketing hype that surrounds gold and silver and versus the market realities. And then he said, try to limit it to 30 minutes. I have about 76 slides, a lot of dividers, misspelled today. I'm sorry about that. But I'm going to try to go through the topics quickly because really the question and answer thing might be the issue. There are some specific characteristics of the gold and silver markets that you need to pay attention to. They're not exactly commodity markets. They are hybrid assets. They're financial assets as well as commodities. And if you look at them, they trade the way that major currencies and the US Treasuries securities trade. They don't trade the same way aluminum or oil or oats trade. There are a lot of characteristics that are very common. One of the things that you'll hear people say that's inaccurate is that you have this enormous concentration of futures trading in gold and silver that you don't see in other commodities. And the reality is that trading and banking and commodities finance have all become extremely specialized. And the concentration of trading in futures and options across commodities is pretty much in line with gold and silver. In fact, in some comparisons, silver and gold look less concentrated. The reality is that if you look at the oats market or the soybean market, you might have even fewer large dealers or brokers or traders handling the bulk of the physical and financial transactions there. Gold and silver do trade like currencies. One of the closest correlations is the way the Japanese yen trades compared to the way gold and silver trade. And that probably is because unlike the US dollar or the euro, the Japanese yen only represents about 5% of the currency market. So it's a much smaller market, and it's more of an aside than it is a main trading thing. Our research since the 70s has repeatedly come to the same conclusion. It's investment demand that is the key factor driving prices. And investment demand, in turn, is driven by largely economic, financial, and political developments and trends rather than supply and demand fundamentals of the metals. If you think of it, it's the macroeconomic environment and political environment that determines whether or not investors feel they should be buying more or less gold or silver. And then the investment demand trends drive the price, and the price has a greater effect on mine production, secondary recovery, and fabrication demand than those factors have on the price. In addition to that, there's an interesting dichotomy between gold and silver. You'll see it in some of my charts. When investors are bearish on gold, they buy less gold. In the half century that we covered data since gold prices were freed in 1968, What you see is about 3 years in which investors were net sellers of physical gold, and they were very small amounts. In contrast, when investors are bearish on silver, they will sell silver, and they'll sell a lot of it for a long period of time. And you'll see these charts later. You'll see a 15-year period from 1990 to 2005 when investors sold close to 2 billion ounces of silver because they were bearish on it. And you'll see in various periods of time, both in the 70s and in that period, that 15-year period, as that period of net selling by investors approaches its end, investors will be smaller and smaller net sellers as they start to turn their attention and think, well, if I wait until tomorrow to sell my silver, I might get a higher price. And as they pull back from selling, net selling, the price rises, and that reaffirms the view that, hey, we should sell less or we should wait. And other investors see the price rising and they come in. Gold and silver are highly secretive markets. It's one of the things that attracts people and governments and companies to these markets, but it also makes them extremely vulnerable to misinformation. You have bad data, you have marketing disguised as research, you have poor, sloppy methodology, and you have a lot of belief-based commentary. These are asymmetrical markets. And that opens up the possibility of outsized profits for people who can have a better stream of information and analysis and data than others in these markets. So who are we and why listen to us? I studied journalism and political science, international economics in university. And in the 70s, when I was doing that, a lot of the international economics were commodities based: oil, gas, gold from South Africa, precious metals, platinum and copper from Russia. In 1980, I took over what was the J. Aaron Research Department, and they produced basic reports and cobbled up data in these secretive markets on gold and silver and some other commodities. Mining information is readily available. Mining companies tend to be public. They tend to have regulatory requirements that they disclose a lot of information about their operations and output and costs. And they have an economic incentive to disclose that information because they want to attract investors to their companies. Secondary recovery tends to be done by private refiners. Fabrication demand is done by large corporations as well as a lot of private non-public companies, and investment demand in central banks. None of these have regulatory requirements that disclose what they're doing across commodities, not just gold and silver, but across commodities. And as a result, they also have an economic disincentive to disclose that information. The last thing that an auto company wants to do is say, we are switching our formulas on our auto catalysts away from palladium to platinum, because investors will hear that, they'll buy platinum, they'll sell palladium in advance of the auto industry. So there's a lot of secrecy there. That's why J. Aaron in the 1970s, before I came, developed a research department to come up with its own set of statistics on supply and demand and investment demand, and to actually analyze that data. I took over the department in 1980. We merged into Goldman Sachs in 1981. In 1986, I bought the commodities research group out of Goldman Sachs, set up CPM Group. I didn't think that research should be part of an investment bank or a trading operation. I thought that research, I thought that I could maximize the revenues generated by research. And if I happened to be a company that I owned instead of Goldman Sachs, the maximization of the revenues would accrue to me instead of Goldman. So we have produced these yearbooks ever since then, 1986 when we left. We actually created the World Silver Survey. You could see it looks a lot like the Precious Metal Silver Survey that CPM Group was producing. We produced the World Silver Survey and created that program for the Silver Institute in 1989, 1990. The first report was 1990. And the purpose of that was the Silver Institute had come to us and said, why are silver prices so low and declining? And we said, because investors aren't buying it. And there were a variety of reasons for that. And they said, can we take a stripped down version of your quarterly silver survey and send it around for free? We said yes. After the first 5 years, we walked away from them. We found that it wasn't really a good relationship for us. And we've continued to produce our books. They were rebranded as the yearbooks at some point. We also do gold and platinum group metal yearbooks, and then we do high purity manganese, molybdenum, tantalum, niobium. We're talking about hafnium. And then we do special projects on other metals, vanadium, tungsten, whatever investors want. So we have a lot of history, half a century of experience, knowledge. We have global contacts. We're plugged into the markets. We actually work with producers and institutional investors and family offices and central banks and others to help them manage their exposure to commodities. That gives us insights that you don't get as a desk analyst. We have a reputation for being unbiased and for having a high degree of integrity. We sell research and analysis. People pay us to be right. They don't pay us to market silver or to convince investors to buy it. These are our intermediate term gold buy recommendations, buy and sell recommendations. And you can see from 1980, when we started keeping records through 2000, we were back and forth. About 68% of the time we said, hey, you should probably be short gold rather than long gold. In November of 2000, we changed that. We issued a buy recommendation that was in place until September of 2011. We issued a buy recommendation in 2013, a little bit premature. The price was flat to lower for about 5 years, and now it's starting to rise again. I won't bore you with the details, but if you had taken our advice, you'd be a lot better than if you were just bought the gold in 1980 when we said sell. This is silver, very similar. Talking about gold, this is that first chart I was talking about. This is net investment demand for gold. And the black bars are more than 20 million ounces, except for the one that we got the wrong color. And the lighter blue colored bars are less than 20 million ounces, or less than 20 million ounces. And you can see 3 red dots where investors were net sellers as a group. And the 20 million ounces for many years was very easy. If investors were buying 20 million ounces or more, the price tended to rise. There'd be an economic crisis. There'd be political problems. People would get worried. You'd have a recession. You'd have an oil embargo. People would buy gold. The price would rise. Things would get better. They wouldn't buy as much gold and the price would fall back. That changed after 2020, after 2021. And since 2022, you've seen a long period of time when investors bought more gold. More investors bought more gold in different parts of the world at higher prices than ever before in history. Anglo-American did a big study back in '66, which really was the origin of our database. And they concluded at the time that there was about 340 million ounces of gold owned by private investors worldwide. And between 2002 and 2012, investors bought more than that. Got a little bit bearish 2013, 14, 15. Then they bought a little bit more. Then they got a little bit more bearish in 2018, 2019. The 2020 came along, the pandemic, the economic lockdown, the recession, and investors bought 40 million ounces of gold, and the price rose sharply. Over the last 2 years into this year, they've been buying 26, 27, 28 million ounces. Enough to keep the price high and at record levels on a quarterly and annual average basis, but not enough to continue to drive the price up at a 15% level the way it was in 2020. That said, CPM Group's projections, just because you might care, our expectation is that the price of gold may rise 10% this year, and it might rise 10% next year, and that we already are at record gold prices in terms of annual and quarterly average prices, our expectation is that the prices will rise quite sharply going forward. And I just realized that I forgot to put any price charts into here per se. There are some charts with things. Let's talk about investment demand. One of the myths you hear is that gold has a very high correlation to inflation, or that gold trades against the dollar, or gold trades against the interest rates. And here you can see the statistical correlations on monthly changes in those various variables, either financial assets like T-bills, T-bonds, and equities, or economic variables like the dollar's trade weighted value or inflation. And you can see the top line, 1970 to 2021, inflation has had a 9% correlation with gold. Gold is a good inflation hedge, but it doesn't move tick for tick. Gold is a good hedge against currency unrest, including volatility in the dollar, but the correlation is negative 34% over time. And you can see periods of time like 1978 to 1982, when gold price and the dollar were both rising. Because gold and the dollar are the two assets that people turn to in times of severe economic constraints. People will trash the dollar, they'll trash talk the dollar, but when things get really nasty, they buy the US dollar. Dow Jones, S&P, T-bills, T-bonds, very low correlations. And that's what you want if you want a portfolio diversifier. You don't want something that has a high negative correlation. You want something that's uncorrelated. There will be times when they're both rising. There'll be times when they're both falling. There'll be times when they're moving separate. And that helps you in the long run in terms of your overall value of your thing. Again, just focusing on gold and inflation. Gold went from $250 an ounce in 2001 to $2,000 an ounce over the last few years. And until 2021, inflation was low and falling. Inflation peaked in 1980, and it fell sharply in 1983, 84. And it's basically been below 4 or 5% for most of the last 40 some odd years. And it declined over that period of time. And from 2000 until 2020, the first quarter of 2021, when inflation started rising, you saw inflation actually deteriorate further while gold rose tenfold. So it is a good inflation hedge, but it doesn't move tick for tick. Another thing you hear is that the dollar is collapsing. And you can see on the left-hand side, this is since the trade-weighted dollar since 2019. You see it rose very sharply in 2021 and into November of 2022. It's fallen since November of 2022, but it's still higher than it was most of the period of time from 2019 through 2020, the middle of 2022. And then if you look at the right-hand side, this goes back to 1970. The dollar was freed to float in August of 1971. And you can see that the dollar has been in a long-term downward trend, at least until around 2013, 2014. And it's risen very sharply. And while we have seen a correction over the last 5 months, that correction put in a historical context, you still have a very strong gold price, a dollar price. Gold versus interest rates. Negative real inflation adjusted interest rates are positive for gold. High nominal and real rates tend to be negative for gold. And this is a scatter plot of real gold price changes versus real interest rate changes. And the correlation is negative 16%. It's not that interest rates rising is negative for gold. What you have to look at is why are interest rates rising? And what do the financial markets expect about that? If the financial markets see rising inflation and they see rising interest rates and they say the Fed is going to quell inflation without throwing us into a recession, that's negative for gold. If they see rising interest rates and they say the Fed can't control inflation, inflation is going to continue to rise, that's positive for gold. which is why you saw gold prices very strong over the period of 2021 into 2022, when inflation was rising. Since the middle of 2022, inflation has started to come down. Interest rates were started to be increased in March of 2022. And by July, you start to see inflation coming down. It's still high, but the trend has been lower for the last 9 months. And in that kind of environment, investors have cooled a little bit of interest in gold. If you look at a efficient frontier for our portfolio, you start with 0% gold, 50% S&P, 50% T-bills. As you add gold, you see that the risk, the volatility of the value of the portfolio declines until you get to around 20%. The risk declines and the returns increase. This is historically 1968 to 2020. After 20%, you start seeing that both the risk and the returns rise, but you're having less risk increase than return increase up until about 25–30%. That's the sweet spot historically. Silver, it's very similar. And yet, gold and silver represent less than 1% of global financial wealth. You can't really see it, but there's little on the left-hand side, there's a little red line at the top. That's gold. Gold has basically been less than 1% of private sector financial wealth since 1980s, 1990. And did increase during the bull market from 2000 to 2012, and it came down. And a lot of that increase actually was capital appreciation as opposed to the actual increases of volume. This is how we try to decide at CPM Group, are we bullish or bearish on gold on an intermediate term basis. We look at it as an inflation hedge, a safe haven, a currency hedge, a form of savings, an alternative asset portfolio diversifier, and as a commodity. These are like the 6 broad categories that a lot of investors will look at. And then we rate them green, red, or yellow. And you can see over the last 2 years, everything except as a commodity have basically been flashing green, which means we expect higher gold prices. And gold as a commodity has been yellow. So it's not negative, but it's not necessarily screamingly positive. These are ETF holdings. ETFs came into being around 2004, and they have become a way for a lot of investors to buy gold and silver and platinum group metals. There's a big difference that you'll see between ETFs for gold and silver, and there's a big difference, we think, between the type of investors that invest in gold ETFs and silver ETFs. In gold, we think that most of these investors are people who otherwise would be buying mining shares as opposed to gold bullion. And you'll see that in that the holdings rise with the price, they fall with the price, they rise with the price, they fall with the price. Silver is a little bit different, and we think that what you have with the silver ETFs are a lot of people who used to have 1,000-ounce bars or 100-ounce bars, and for a variety of reasons, they have sold those and put their silver assets into ETFs. Gold coins have been very strong the last 2 years, 3 years since the lockdown, and that's continuing. On the supply side, the dark part is market economy mine production. It's off from a peak around 2016. It's been flat. It fell sharply during the pandemic, and it's been rising very slowly ever since then. There hasn't been a lot of investment, capital investment in replacement reserves, much less expanding reserves. The red part is secondary supply, recovery of gold from old scrap. We exclude the processed scrap that's generated by manufacturers making jewelry and electronics and such. On a worldwide basis, this is the data that everybody uses. It comes from S&P. And you can see the rise and the fall of worldwide exploration budgets for hard rock, and the dark blue part is allocated to gold, and it represents roughly half of the amount of exploration dollars going into it. There are a couple problems with this data. It's not adjusted for inflation, and it's not adjusted for the fact that there are different numbers of mining companies that they survey. Back in the 80s and 90s, they were surveying collecting data from about 200, 250 mining companies. As the bull market for hard rock metals, not just gold, but other metals too, progressed after 2000, the company that S&P bought that used to produce this hired more people and increased it so that by the time they sold their company around 2011, they had 2,000 companies in their catchment. So you really have to adjust it because you're collecting data from 10 times as many companies. And a lot of the companies that they added were the smaller companies that are much more exploration oriented than the larger companies. They sold themselves to somebody who laid off most of the people who knew anything about mining. And the number of companies went from 2,000 to 1,500. CPM Group and other people pointed this out to them. They did things to change it. And all of a sudden they found 2,500 companies. So they probably had 500 companies like Golden Nugget Casinos. They had gold in their name. So this data is what everybody in the mining industry relies on. Not adjusted for inflation. It's not adjusted for methodological changes or the census of the survey, the number of companies that they're surveying. And yet, this is what we make our decisions on. New capacity additions, very high in the period 2011, 2013, coming at the end of a decade-long bull market. As we entered a 5-year downward leg, exploration dried up, capital expenditures on new capacity dried up, and we saw it fall, and it continues to fall. And you can see that while we have a little bit of an increase projected for this year and next year, it's still very low compared to the levels that it was at the end of the previous bull market. And then these are costs, all-in sustaining costs, and the gold price is the top thing. All-in sustaining costs. Costs tend to follow the price. When the price is high, mining companies will spend more. They will spend a lot of money on their home office, on exploration, on capital. So the sustaining costs are more price sensitive. They get slashed first and they get rebuilt first. The cash costs, the operating costs to maintain the mines and continue production are a lot stickier. You can see cash costs $900 right now, all in sustaining costs about $1,300 on average. So you still have an industry that's relatively profitable right now. Fabrication demand has basically been flat now for about 20 years. We had a downward period during the Great Recession and the global financial crisis, 2008, 9, 10, 11. It picked back up, but it didn't really exceed pre-recession levels. 2020 came and hit it hard again, and it has picked itself back up almost to pre-2020 levels, but still not there. And the big factor is jewelry. Jewelry uses most of the gold that's used in fabricated products. Central banks are the other big source of demand for gold for stock purposes. We divide our balance sheet for gold is total supply, mine production and scrap, and other supplies. Fabrication demand, which is fabricated products using gold and changing it into something else, jewelry or electronics or something else. And then there's stock demand, which is private investment demand. I showed you the chart earlier, and central bank buying. Central banks bought a lot of gold in the 50s into 65 because it was used for international settlements. And central banks would have a surfeit of dollars. The US government said the dollar is fixed at $35 an ounce. Central bank said, okay, Americans are buying a lot of goods from our country. We're getting a lot of dollars coming in. Here are our dollars, give us your gold. That ended really in 1967, 68. President Johnson closed the one gold window in 68. President Nixon closed the other official gold window in 1971. And you entered this period of time when central banks said, well, okay, we've got all this gold, what are we going to do with it? And then they started lending it out and they started selling it. And the bulk of the gold that was sold from 1989 until 2007 was gold sold by European central banks. Canadian central bank and the Australian and Japanese central banks sold a lot of gold too. These were countries that were involved in a lot of international trade back in the Bretton Woods period of time when you settled your foreign currency accounts by selling gold, by selling dollars and buying gold. They were lightening up. A lot of these central banks had 85, 90, 95, 97% of their monetary reserves in gold. They really needed dollars to protect their currencies. In addition to that, the Maastricht Accord in 1989 said, January 1999, any country going into the euro and the European Central Bank deal, in order to change their monetary reserve balances, i.e. sell gold, they have to get prior approval by the European Central Bank. So from 89 to 99, all these central banks that had 90% of their gold, monetary reserves in gold, were selling half of their gold. England went from 20 million ounces to 10 million ounces. Switzerland and England actually waited because they didn't go into the euro. And they were very gentlemanly. They said, we won't sell until 1999. So before 1999, it was other European countries selling their gold. After 1999 into 2007, it was England and Switzerland primarily. By 2007, they had finished their sales programs, and other central banks, India, China, Russia, Kazakhstan, that hadn't been major trading counterparties back in the Bretton Woods days, had enormous amounts of gold, dollars. And they started diversifying their monetary reserves by selling dollars and buying a basket of other currencies and gold. So you had this overwhelming, overriding impulse among central bank monetary reserve managers to diversify their portfolio. Those central banks that had too much of their assets in gold were selling gold and buying dollars. And those central banks that had too much of their assets in dollars were selling dollars and buying gold. And that's really what the shift has been. And I'll show you some more data over here. I think it's worth paying attention. Central banks are price sensitive. When the price rises, they buy less gold, typically. When the price falls, they buy more gold. When investors are bidding the price higher, central banks will pull back. When investors say, well, maybe that was stupid and I shouldn't have been buying so much, and the price declines because the central bank investor demand declines, then central banks will pick it up more. If you look at 180 central banks, 2022, you had 8 central banks that were selling. Actually, this is an old number. It's a little bit higher, but it was a handful of central banks. Kazakhstan sold some, others. If you look at who central banks that were buying, there were 22. But if you look at it, of those 22, there were 9 central banks, I believe, that are in red here. 9 central banks that bought more than 500,000 ounces. 8 of them bought, 7 of them bought more than 1 million ounces. So the bulk of the buying was in a handful of banks. China was in there, Russia was in there, no surprises there. India was in there. And the others were Islamic government central banks. A lot of the demand for gold from central banks is coming from the Islamic world. And for different reasons, but you have to pay attention to it. Turkey has been the big entrepot for things going into Russia because of sanctions. And so there's this massive amount of money going into Turkey and flowing through Turkey. And some of that has been put into gold. But, Qatar, natural gas, UAE, petroleum prices. But there are bigger issues in the Islamic world that's driving that. Russia is the obvious one. China has an enormous amount of US dollars. These are Russian monetary reserves. The gray part at the bottom is the dollar value of their gold reserves through February of this year. And I'll show you monthly in a second. Most of the foreign exchange, 2/3 of the foreign exchange is frozen since they invaded Ukraine. And so gold has become more important. These are those monthly changes in the gold reserves on a different scale. So you can sort of see selling gold, buying gold. They've been using gold more as a place to store their money because they really don't want to store it in euros and dollars. And then when they need it, they sell it. These are monetary reserves. And on the right-hand side is gold as a percentage of monetary reserves among central banks. And, you can see it was much higher during the Bretton Woods era. After Bretton Woods and during the period of gold demonetization, it fell down to about 10%. It has started rising. And in terms of the value of it, even though central banks had sold like more than 100 million ounces of gold from 1971 until 2006, the dollar value rose because they had also allowed the gold price to float. And these are monetary foreign exchange reserves. So these are excluding gold and SDR positions and positions in the fund. These are the foreign exchange reserves of central banks. And people will tell you that central banks are dumping the dollar, but they're not. There was a period of time in the early 90s as you moved into that January 1st, 1999 euro change, where any central bank that was going into the euro had to get rid of the other currencies it had in its foreign exchange reserves that were going into the euro. So they were selling their Deutschmark and their franc and their Spanish pesetas and their guilders and other things, and they were buying dollars. And you saw the percentage of foreign exchange reserves go from about 58% to about 72%. And then it slowly came back down. And really for the last decade or so, it's been 58 to 62%. Central banks are not dumping the dollar. And they have a lot of problems doing that because the liquidity for alternative currencies and gold are not there. The euro represents about 20% of foreign exchange reserves. It's a fraction of the liquidity that you have in the dollar. The pound, the yen are about 5% each, and everything else is about 10%. And yes, no one holds Russian rubles as a foreign exchange reserve. If you have rubles and you're a central bank, you sell them and you get something else. So the dollar has a hegemonic capacity to stay important simply because if you tried to move too quickly away from the dollar, you would have hyperinflationary pressures in those other countries where you were trying to buy currencies that don't exist. There's been an impulse since at least 1980, 81 to reduce the dollar exposure by the part of central banks. But it really has been very difficult to do because if you're not going to hold the dollars, what are you going to hold? So that's that. And I think I'm done with that. So I'm going to move on to silver. And I'm pretty much out of time. Silver prices fell. They rose in the first quarter of last year. People were worried about inflation. They were worried about recession. They were worried about interest rates rising. Then Russia invaded Ukraine. And the price went from $22 to $28. Then it came down and it fell basically into September, started rising October, November, went flat December and January, fell in February as inflation was looking like it was maybe under control and the Fed was the financial markets were starting to listen to what the Fed was saying about what it was planning to do with interest rates, as well as other central banks. And then in March, you had the banking crises and silver prices rose, but they have basically stayed below $26. They averaged $21 last year, down 13% from $25 the year before, still the fifth highest level on record. First 4 months of this year, they were about $23. Our expectation is about $24.50 for the year. We do think that prices will rise further in 2024 and 2025, but we're not really looking for it until later. A long-term silver price chart, you saw the big spike in 79 into January 1980, and then it came down. Same thing in 2011, spiked into April of 2011, and then it came down. Kind of stayed up high for a couple years, and then after 2013, it came back down and traded around $15 for several years until the second half of 2019. I don't pay attention to the gold-silver ratio, but other people do. So we throw it into our presentations. Another thing that you keep hearing is that the silver market has this massive deficit. And that's not true. Silver marketing promoters, companies that are charged with getting investors to buy silver, will add investment demand to their fabrication demand and say, oh, the market's in deficit. But that's not economics 101. Surplus deficit should be total supply less fabrication demand. Newly refined silver, I'll show you in a sec, has been basically above. We've been in a surplus for 17 years. During that 17 years, we've had 2 spikes in the silver price, even though you've had a surplus. And that's because the surplus represents investment demand. And investors were bidding up the price of silver from 2006 into 2011. And then they kind of cooled their heels and the price came off. And then in 2019, 2020, 2021, they bought again. And in 2022, you can see that's the second last bar here. It was about 40 million ounces, 38 million ounces. And the price basically was off 13%. So this is the dynamics. And then again, as I said at the outset, if you look at silver, one of the big differences between gold and silver is when investors are bearish on silver, as they were in the 70s, and from 1990 to 2005, they will gladly sell large amounts of silver. And then when they turn bullish on silver and start buying it, there's a backup of metal that's there, as in contrast to gold, where if an investor wants to buy gold, they have to buy newly refined gold because most people who hold gold aren't selling it. There's also a tremendous amount. So we don't have deficits in silver. We have surpluses. If investors don't want to sop up that surplus, the price falls. In addition to that, you've got about 5.6 billion ounces in above ground refined silver bullion inventories. 2.3 of that is in coins. And then another billion ounces in ETFs. And then about 2-point-something billion ounces in unreported estimated reserves, half of which is probably working inventories for mines, smelters, refiners, fabricators, and everybody else. Just thinking about one of our clients that is a substantial portion of that. Silver inventories fell sharply in London last year. They also declined in New York, but not as much. The world's not running out of silver. If you look at where that London silver went, about 180 million ounces was exported into India. And of that 180 million ounces, about 30 million ounces was then re-exported from India into Hong Kong and other Asian countries that needed it. Most of this went into fabrication demand, jewelry and decorative items, as opposed to investment products. Canada imported about 76 million ounces from the UK, but most of that was actually bound for the US It was shipped into Eastern Canada from the UK and then trucked down into the northeastern part of the United States to meet investment demand and to meet industrial demand. Switzerland imported 40 million ounces. Turkey, again, flush with cash because of its role as the conduit for goods into Russia. They bought a lot. Turkey is also the regional market center for gold and silver for the Near East. Fabrication demand, again, basically flat for the last 20 years. We've seen important shifts. Photographics gone away, solar power has risen, electronics has increased, and jewelry demand contracted, then expanded, then contracted, and then expanded again last year. Most of that expansion in jewelry was in India and Asia. Silver use in solar panels, non-existent 20 years ago, about 120 million ounces last year, about 128 million ounces this year projected, and going up probably to about 180 million ounces over the next decade. Silver use in the auto industry, which we include in the electronics figures, also has been rising. Kind of came down with a peak in the auto and a drop in auto there, and then it started to rise again, even though the auto industry is relatively weak. But a typical petroleum-powered vehicle uses an ounce of silver for a light-duty vehicle, and a typical electric vehicle uses 1.5 to 2 ounces. So as electric vehicles are taking market share, and they're up around 10–11% of the light-duty vehicle market last year, they are using more silver. Supply, I do want to go fast because the stuff at the end I do want to touch. Again, weak trend in new mine capacity because of it. Low costs, plenty of reserves. The world's not running out of mineable silver either. Refining, there's been a big growth in refining capacity for gold and for silver in diverse parts of the world. And part of that is a diversification of the location of refining. There's plenty of capacity now. If anything, there's probably excess capacity to refine gold and silver on a global basis. But part of it is a diversification of the location for a lot of the refining. In addition to that, you've seen an increased number of refiners over the last 8 years become LBMA certified good delivery refiners. And they've done that because of weaker fabrication demand for the metal. If you're selling metal to a fabricator, you probably don't need the LBMA certification, and you don't want to cast bars because most fabricators don't want bars. They want sputtering targets, or they want sheet or grain or wire. But if you can't sell all your metal to a fabricator, then you're going to need to sell it to a financial intermediary, a bank or a bullion trading company. And in that case, you're going to need good delivery bars. So as the market weakened after 2011, what you saw was an increase in the number of refineries that were going through what they don't really like as an LBMA certification process. And, you know, Terry asked me, is there significant merit for producers to get into that? And the answer is no. You know, if you're a miner, mine. If you're a refiner, refine. And if you're a miner, don't think I can do refining better than a refiner. So Terry also asked me to talk about market realities versus market hype. And I want to run through a few charts here. Markets are, I've gone through this. Here are some things that were quoted. The Fed won't let the Bundesbank have its gold for 7 years. This was back in 2014 when ultra-conservative neo-Nazi members of the Bundestag demanded that the Bundesbank repatriate some of its gold from New York, London, and Paris. The reality, that's not what happened. And what we did, and you can see it online, I think I even have it here. You can go to YouTube and watch this video we had the head of foreign exchange and gold trading at the Bundesbank come over in March of 2014 and give a talk about what was going on. And basically, it was very simple. Germany built its gold reserves from 1950 to 1965. The definition and qualities of good delivery bars changed like in 1979, 1980. The gold that Bundesbank had at the New York Fed and London and Paris was not good delivery. So rather than move non-good delivery bars to Bonn, to Frankfurt, where the gold is stored in Frankfurt, they had it refined and upgraded into good delivery bars. And that takes time. But that doesn't stop the conspiracy theorists. Comex will run out of gold. This was from 2014. It hasn't happened yet. All the gold in London and Zurich is going to Asia. I want to show you the next 3 slides. And higher interest rates will push gold prices lower. Nominal interest rates remain close to zero for the past 7 years. And real rates remain negative, and gold prices rose sharply. That's the data on Swiss imports and exports. You can't see it. This is the chart. Yes, we saw a big increase in gross exports from Switzerland into Asia from the period 2008 into 2016, and it's still continuing. It's like 40 million ounces a year. But we also saw gross imports rise and stay higher than gross exports. Net imports were 20 to 40 million ounces during that period. They did dip down to about 10 million ounces for 1 year in 2013 after the gold price came down from 1,800 to 1,280, and then they rose. So Switzerland has been adding gold to its net holdings, not the Swiss government, but investors who want to store their gold and silver in Switzerland. They've been adding gold and silver to their portfolio, to their holdings stored in Switzerland since 2008. Swiss gold imports, net imports, 374 million ounces since 2008. Compare that to China, where gold investment demand in the same period of time was 136 million ounces. Investors storing their gold in Switzerland, and maybe they're Chinese, stored almost 3 times as much gold in Switzerland as they did in China over the last 15 years. So Switzerland's not running out of gold, and neither is England. Bad data. One of the things that happened in the early 90s was that certain people started saying that when a producer sells forward, it's somehow or other spot gold increases, that gold that's held in sterile inventories off the market is somehow utilized to hedge those producer forwards. Total nonsense, doesn't happen. But for strategic reasons, certain people started talking about that. And for strategic reasons, other people, banks, allowed them to do that. The result is that with silver, you overcounted supply like 314 million ounces from 1987 to 2005. And then you added another 250 million ounce overcount. So 500 million ounces of miscount. Then you say, okay, there's 500 million ounces of silver that I am saying was physical silver. Where did it go? Well, I can't figure out where it went, so it must have gone to investors. So you start overcounting investment demand. The same thing happened in gold. You had about 103 million ounces in one period and 96 million ounces. So, 200, 300 million ounces of overcounting gold supply. And then you say, well, where is that gold? Oh, it must have gone into investment demand, so you overcount it. In China, there was a change in the rules. The Chinese base metals smelters wanted to bid using international gold and silver prices for overseas base metals concentrates. And prior to 2000, 10 or so, they were supposed to use domestic Chinese prices, which were 10%, 15% lower than the global prices. As a result, if there were gold and silver rich copper, lead, zinc concentrates coming out of Peru, Mexico, Indonesia, Papua New Guinea that had a lot of gold and silver in it, they couldn't bid competitively. So we helped, and the People's Bank of China said, okay, you smelters, if you certify and agree that you will take the gold and silver on refined outturn and export the gold and silver, export the silver. They wanted to keep the gold if they could. If you agree to export the silver, we'll let you use international prices in bidding for those concentrates. So they did, and there was this tremendous surge of byproduct silver that was being refined from imported concentrates that was then re-exported. It was about 1 billion ounces over a decade. Again, you add that to the slosh and you say, okay, now I got 1 billion ounces of forwards that I'm claiming somehow or other involve using silver. And I have 1 billion ounces of Chinese silver that's really, I've already counted it as supply in terms of mine production in those various countries I just mentioned. But I'm not thinking that way. So I have to put it someplace, so it must be investment demand. So CPM Group must be wrong. It's not 100 million ounces of investment demand. It's 300 million ounces. And if it's 300 million ounces, and that's an unprecedented level, the price of silver's got to rise to $50 or $100. And when it doesn't, you don't know why you're wrong. When you're listening to someone like me, you have to say, does he have a justifiable research methodology? Do the projections change as information changes, or are they always saying that the price of silver is going to 50 and gold's going to 10,000? Do they put target dates? We've started a thing called the CPM challenge. If you're going to say that silver is going to $100, tell us when it's going and talk to us when that date comes. And if the date comes and you're just dead wrong and silver is still $24, $25 an ounce, why don't you find a different job? No one's taking us up on it. Are they perpetually bullish? Do they have nonsensical conspiracies and manipulations that they use to project the fact that they're consistently wrong? Are they self-assured that they know more about economics and finance than the hundreds of thousands of legitimate professionals, economists, and financial managers in the industries and the markets and the governments and the central banks? Further reading and viewing. We launched our gold yearbook in March. You can see a 2-hour briefing on it at this YouTube spot. We launched our silver yearbook yesterday. It's another 2-hour thing. If you're interested in further reading about how things get wrong, how is it that people go wrong? You can go to our website, and there's a page in there called The Importance of Accurate Data. And you can find these different articles from 2003, 2014. You can also go to our website and find all kinds of other reads. And at this point, I guess we'll open it up for questions. So Terry, are you managing that?
Yes, I am. Thank you again very much, Jeffrey. There's a lot of data here. I'm sure people are just overwhelmed with this great database you have. No question. Actually, there are questions. Let me start with some basic questions. The gold industry, especially the mining companies, decide every now and then some legal requirements as well as some beauty contest to change their price forecast for their reserves. Do you advise the companies, do they approach you with respect to your idea, your input, besides the legal requirements that they have, what price to use for the resource reserve calculations?
Do we advise the mining companies?
Yes.
Yeah, some of them, well, there are many mining companies that buy our research and our price projections. And we have price projections that go out 3 months, 2 years, 10 years. For platinum, we're taking them out to 2050 right now. For high purity manganese, I think we're going out to 2040 or so. So there are any number of mining companies that will buy our price projections and know what they are. But they tend not to go that way when it comes to what the price is for valuing their reserves and resources. And what they try to do is take a prudent number. And yes, we will talk to them as to what a prudent number is. And sometimes we'll have a company that will come to us and say, I'm using $1,200 as my gold price for valuing my reserves and resources and valuing my overall company. And I'd like to raise it to 1,400. And our advice right now is no, don't do that, because you really want to use a conservative figure, because you don't want to be into a position, as you have been in the past at times, where you have to downgrade your reserves and resources and the net present value of your company because the gold price has fallen lower than the number that you're using. So our view is that 1,200 is a reasonable price for gold. And I think we're probably suggesting like $16 or $17 for silver at present. But our view has always been to be very conservative in what numbers you use in projecting, in valuing your reserves, resources, and overall company.
Thank you for that. Jeff, you
Terry,
also have
Terry, sorry, Terry. One thing, for those who want to ask Jeffrey questions, please click on the chat box, right? And just input your question. And then as soon as Terry finishes asking questions, he'll then read out the questions that you post on our meeting chat box.
Good. Thanks, Carlos. Thanks for that. Jeffrey, you also had shown up shows the operating costs, cash costs, and of the industry, and dollars per ton numbers actually has been climbing up. No question about that. But somehow the industry managed to keep their costs back to the levels were by a few years ago. But the total cost also includes replacement costs as well as other numbers that doesn't really show up in the cash costs. In the last year and the first quarter of this year, we've seen the costs increase in the industry in terms of total costs. What's the projection of the cost that you have that will impact their reserve calculations?
I don't know off the top of my head what costs we're projecting, but I do know that we are projecting higher costs going forward, both on a cash cost basis and in terms of sustaining costs. And that's basically based on our view of projected oil prices, natural gas prices, and overall inflation. So we're expecting the cost structure to deteriorate, not significantly, well, significantly, but not catastrophically.
Okay. The industry has been very successful actually to optimize and manage their costs, although the grades are coming down in a lot of the operations. Just another question that we come across a lot is the cost of refining. Like every other industry, there's a refining imbalance versus the concentrates. In this case, it's doré most of the times. It's not a big issue like in the case of copper or zinc or anything like that. But there are a lot of refineries that have been built around the world the last couple of years. Most of them, or some of them, not being good delivery, for instance. But how much of an impact that's having in terms of demand for doré or the gold concentrates or scrap or whatever? Is there an imbalance between refineries and the source of gold, either mining or scrap? And how much is it impacting the producers that we have in Canada, for instance, for their refining costs?
I'm not sure how about the second part, but yeah, you definitely have seen this enormous competition and scrounging for doré on the part of refineries and refineries around the world. And it all comes down to a matter of having the better price. And the trading companies, a lot of times the mining companies don't necessarily negotiate with the refiners. They will negotiate with a trading company, which will then in turn negotiate with the refiners or smelters, if in the case of concentrates. And the trading companies have been extremely aggressive in bidding the price, the refining costs down because of the increased competition from the new refineries that have been added. Does that answer your question?
It does. It does. Obviously, some locations like Dubai, we have a lot of new refineries built. South America, we have refineries built from nowhere, and they are actually competing with a lot of the source to refine it. And then the question is that how does the market absorb that output, which is not so-called good delivery?
Well, as I said, excuse me for a second. It's been an interesting transition over the last 15 years or so. But there were a lot of major refineries that were not producing good delivery bars. And they were doing that, they were not doing that. I don't know how it is in Canada, but we have a record year in terms of pollen in New York City. They were not producing good delivery bars because they could sell all of the gold and silver they wanted to directly to fabricators who did not necessarily want bars and did not necessarily require good delivery certification. They were saying, if you meet the good delivery refining specifications, that's fine. I don't need a LBMA recognized or a Comex recognized good delivery refinery. I need metal that meets these specifications. And in terms of form, as I mentioned in my presentation, most fabricators don't want bars. You know, they have to melt the bars down to make the forms or shapes that they want. Fabricators that cast want grain or the little beads of gold and silver. And even other companies that will like make sputtering targets, which are a very popular intermediate product that's used in electronics, but also in catalyst manufacturing and in jewelry. They prefer grain too. So if you're a refinery, excuse me.
Let me take over here. You'll come back to it. In the meantime, there are some questions about the investment merits of the silver or the gold companies, including one that says, would you recommend, what's your thoughts about the silver royalty companies and investment? I know you don't give any investment advice, but you may think about that question and give an answer. But in the meantime, the S&P data on the exploration, you're absolutely right. There are adjustments to be made for the gold exploration numbers. In the meantime, do you think that the ETFs, as well as the investment demand for gold, has taken money away from exploration? Not
Yes.
Investing in junior companies, or even for.
I think there are several things that have constrained capital formation for the mining industry. And one of them is, as I said, in the gold market, it looks like a lot of people who formerly invested in mining companies, including exploration and pre-development companies, have shifted and they buy gold or gold ETFs instead. And so you've had a reduction of investment into the mining industry from those investors. In addition to that, at the other end of the investment spectrum, you have a lot of institutional investors who have been moving away from investing in individual companies, and they are investing in stock indices and ETFs and index funds. rather than individual companies. And there are a variety of reasons for that shift. And it's not just limited to the mining industry. It's having a negative impact on capital formation for a number of companies and industries. And as a result, you see less money being raised through the equity markets that goes into companies' coffers that can be used for exploration and development than you used to. And it's a trend that's been going on for at least a decade, probably longer. And those trends are going to probably persist and on the institutional side, probably get worse. So that's a real problem.
Okay. Do you see any questions, Carlos, in the chat?
Yes.
Okay, please.
Bear with me for 2 seconds. Okay, so there's two
Just give me
questions.
1
Okay,
second while I get some more water.
it sounds good to me. While we're waiting for Jeffrey to come back, if you do have questions, feel free to post them on a meeting chat. Just go on to the bar and click on chat, and then you can post them there. There's currently 2 questions. One of them is, given the current inflationary cycle, do you think that we will reach $3,000 per ounce for gold during this decade?
I think that gold will reach $2,000 per ounce. Was it 2,000 that you asked?
3,000.
3,000.
How much?
3,000.
It's possible that we would see 3,000 on a spike. Unfortunately, I didn't have that gold price chart that I meant to drop in. I did have the silver one, and you see these enormous shots up. So people know, oh, gold went to $850 in January 1980. They don't necessarily pay attention to the fact that the biggest decline, the biggest price move in gold prices until just a couple of years ago was the day after it hit 850. You know, it closed that day around 810 or so, and it fell $140 the next day to something less than $700. And the average price was 600. So when we project prices, we project annual prices out 10 years for gold and silver. And we say, we think that the gold price will rise to a record price, not at 3,000 on an annual average basis. But when you start talking about, well, how do you project those spikes? That's a wet finger in the air. And there are people who try to do all kinds of things that are economically illegitimate, you know, to come up with it. So if we think that the gold price could go to an average price of, say, $2,400 an ounce over the next 5 years, yet in this decade, the idea that the price could spike up to 3,000 is within that realm, right? Okay. Because again, if you look at the relationship between an intraday spike and an average price, that is possible. I'm not sure that we expect it, but depending on the economic and political conditions at the time of the next spike up, and we do think there will be another spike up, and we do think that it probably will be within the next 3 years. It's quite possible that you could see that.
Okay. I've got another question here. It's related to crypto popularity, but the question is, how do you see the rise in crypto popularity affecting the demand on gold?
Ultimately, I think cryptos will be very good for gold because I used to say the cryptos are going to be a disaster for investors. And they're going to lose all their money. Wow, this is bad. But the reality is this. In January 2022, the market cap of the crypto market was $3 trillion. In December, it was 800 billion. Crypto investors had already lost more than 2/3 of the value of those cryptos. And if you think of the crypto the private crypto market, the other 800 will go away. You know, and I think that ultimately cryptocurrencies will be very beneficial for gold and silver because it will cause those investors who have thought of them as alternatives to gold and silver to realize that they were buying pet rocks. You know, they were buying internet startups in 1999. They're empty shells with no protections. And as that market deteriorates and collapses, it'll be good for gold.
Okay. I believe that somebody had sent you inadvertently 2 questions.
Me?
Directed to, yeah, exactly. If you can read them out, that'd be great.
4. I have
It
4
should-
questions here.
Yeah.
One
So
is, would you concur that the stock of above ground in the hands of governments, banks, individuals is many times larger than the amount of gold mined annually? Oh, yeah, yeah. And that this drives the market nature of gold. Oh, okay, now. Central banks own about 1 billion ounces of gold. Private individuals and companies own about 2.3 billion ounces of gold. That's 3.3 billion ounces of gold held by those people in bullion form. And annual mine production is something like 100 million ounces. So yeah, there's this enormous amount of gold and silver relative to mine production. And it is the incremental changes in those inventories that have a major effect on the price or what the market nature of gold. One of the interesting things, as I said, is investors, when they're bearish, tend not to sell their gold. So when investors say, they could be new or they could be existing investors who want to add to their holdings, when investors want to buy gold, they basically have to buy it from newly refined metal, either mine production or secondary recovery of metal, you know, because the people who hold gold, generally speaking, don't sell it. So that's really the factor. You know, I hear a lot of people talk about how the futures market determines the price. The futures market determines the price on a daily basis or hourly basis, but the longer term gold price, again, it's like you're talking about the intraday price or you're talking about the annual average. The longer term price of gold is clearly determined by physical gold supply and demand, including investment demand. And yes, there's an enormous amount out there, but it's interesting because, as I said, it tends not to be sold. Silver, you'll see a lot of silver sold when the price spikes. May I please get a copy of this presentation? We will make this presentation available to Carlos and
I'm gonna
CIM.
yeah. So I'm gonna address that in the next few minutes.
Okay, and I believe the ability to manufacture quality diamonds at a reasonable cost has the capacity of disrupting and destroy diamond markets. Are folks working on ways to manufacture gold alchemy how would that? Okay, I don't know anybody who's trying to make gold out of other things. So yeah, the diamond market has already been majorly affected by the creation of lab-grown diamonds. And not just synthetic diamonds, but actual diamonds that are grown in the lab. And that is going to continue to disrupt that market. I don't know anybody who's doing that in gold. And I'm not quite sure how you would do it in gold, because with diamonds, you're taking carbon and you're processing it. With gold, you would be taking gold and you would be processing it. Yeah, it's what's going on with diamonds is not alchemy. It's reproducing the heat and pressure in a short period of time that is applied to carbon to make diamonds underground in a long period of time. So I don't think it's really, you know, quite there. And then what is your thoughts on silver royalties as an investment? Royalties are interesting because you're avoiding a lot of the capital and operational costs. You're not really avoiding it, but you're stepping one place removed from it. Royalties have been very popular, and I think they continue to be, and they make sense. Those are the four I've got.
Okay, wonderful. Okay, so that concludes our questions. I'm just going to share the screen for 2 seconds. Okay.
Carlos,
yeah.
just one last question. For market watchers and geopolitics of the world today, the facts are, number one, the big producers of gold are China, Australia, Russia, in that order, I guess, or almost that. And number two is that we've seen constant purchases by Russians and the Chinese for the central banks. What should we watch for? How much data they disclose is at their discretion, and when to do it, I assume. You agree with that?
Yes and no.
Okay.
I mean, yeah, they're both, China and Russia are both members of the IMF. And the IMF has policies and practices that member countries are supposed to follow. China has in the past played with those policies. They will put gold into a side pocket and not add it to their monetary reserves. And I can talk about why they do that. And it's basically the fact that the central bank in China, like other central banks, do market making. So there are times when people will come in China, will come to the People's Bank and say, I have gold I want to sell, please sell it for me. And it goes into the side pocket in the People's Bank of China. It doesn't get added to the monetary reserves. And then if they can't find a buyer for it, or if there are reasons why they want to add to their monetary reserves, they'll buy it. So you'll see that from time to time in China. But in 2015, the People's Bank of China changed its gold policies as well as its yuan RMB policies. And it said, we have done that in the past and we're not going to do it anymore. And we have reason to believe that they've ascribed to that. The Russian central bank had been reporting on a monthly basis, as has the Chinese central bank. Well, just going back to China for a second, you'll hear people in the gold market in the West say, well, China hasn't reported its gold reserves since 2019. And that's false. China reported its gold reserves to the IMF every month. And they said every month from the middle of 2019 until November of last year, they have said our gold reserves are X, unchanged from the month before, because they did not buy gold and add it to their monetary reserves from the middle of 2019 until November of this year. And the reason they did that is that when they were buying in the first half of 2019, the price of gold was $1,250 an ounce. And in the middle of 2019, the price went to $1,500. And then by the end of the year, it was $1,800. And the Chinese central bank said, we're buyers at 1,250, not 15 or 1,800. So they stopped buying, and they didn't stop reporting to the IMF. It's just that for 3 years, they were saying, we haven't added to our reserves. Russia's a little bit different. They were reporting every month, and they needed to do that because they have a much worse credit rating and credit worthiness with their trading counterparts than, say, China or even the United States. So they needed to show people that their monetary reserves were there. They stopped reporting. They reported in February of last year for January. And then when they attacked the Ukraine, they stopped reporting. And they started reporting, I believe it was in January or March of this year, they started reporting again. So there are policies that they're supposed to follow, and those two central banks have kind of fudged them in the past. Go on with your question.
No, I think that's something market watches for all the time. And there's always disbelief the numbers they disclose. And secondly, in today's world of geopolitics, I don't see why they're going to be so transparent if they can circumvent the requirements that the signatures that they were to IMF. And that's what the market thinks, okay?
I'll tell you two anecdotes. The first one was like 1988, 89. And we had in our reports estimates of how much gold the Soviet government owned. And it was about 67 million ounces. And it's no secret that they were a client of ours. And they approached us and they said, we're doing our first euro dollar bond. And as part of that, in the prospectus, we're listing our gold reserves. I'm sorry, that's a different story. They joined the IMF in 1988, 89. And they said, as part of joining the IMF, we have to report our monetary reserves of gold. And China, when they joined in 1978, said they had 12.3 million ounces. So when we joined the IMF, we're going to report that we have 12.7 million ounces of gold monetary reserves. And I said, wow, that's like, we've got you at 67. And I guess we have to change our reports. And they said, no. These are monetary reserves. That doesn't mean that the Soviet government doesn't have that other 55 million ounces. It's just that we're not calling them monetary reserves. That was like 1987, 88, 89. Fast forward to the early 90s, the Soviet Union has collapsed. You have 15 independent governments now. And the Ukraine government, the Russian government says, okay, we're going to divvy up the Soviet resources. And we're going to do it on a pro rata basis, given the size of your economy and population. And here's that 12.7 million ounces of gold reserves. And here's what each of you get. And the Ukrainian central bank said, wait a second, we think that the Soviet government had 67 million ounces of gold, not 12.7. Where's our portion of the rest of it? And the Russian central bank said to the Ukraine central bank, this is what we have. If you want your share of the rest, go talk to the Red Army.
Okay.
People will talk about how central banks own gold, but they don't necessarily talk about what other parts of the government own gold.
Got it. On my part, I'm grateful for this presentation, Jeff. You take a lot of time and present and details for our audience to present. But I'll let Carlos have the final say, and thanks.
So thank you very much. Okay, so for those wishing to listen to the recording of this, I'm going to show you where you're going to be able to find it within a week's time or so. So bear with me for 2 seconds. So if you go onto our website, MES, okay, so it's www.cimmes.org, and you just have to choose one, whether it's National, Montreal, Toronto, Vancouver, right? So let's just, because let's stick to, say, Toronto, okay? So if you go here, and on the right-hand side, you will see a menu right here. Go on to highlights of past events, right? And it will be posted right over here, right? So it will be posted over here in the coming week or so. So you'll have access not only to the video itself, but a copy of the slides, okay? So, but at the same time, if you want to see some past events, if you want to listen to some recordings or download slides, by all means, I encourage you to review this and and have a look at any presentations that interest you. That said, MES is not us; it's all of us. Meaning that if you've got ideas as to future events, if you've got ideas in terms of who our next speakers could be for a discussion group, please let us know, right? We're always interested in new speakers. We're always interested in new topics. So please contact us. So by contacting us just by going here, stay connected, right? And let us know. Let us know what you're thinking. And we'd love to hear from you. We'd love to, feature new speakers. We'd love to feature new topics. And yeah, so let us know. And if you want to join MES, if you want to be a contributing member of MES, because we do a lot of good things throughout Canada and internationally, also let us know. We're also looking for new volunteers and looking forward to seeing you as part of MES. So without any further ado, we're going to call this an end to this event. I hope to see you at future events. And if you got this notice by a friend and you're interested in getting future notices from MES, stay connected to us by subscribing to our email list. We do not share our information with others, meaning that if you send us your email address, we're not going to sell it to anybody. It's for means to communicate with you, right? So on that note, we want to thank Jeffrey Christian for presenting today. He did a fabulous job as always. We want to thank Terry for featuring this event, and we want to thank you for joining us today. So without further ado, this concludes our meeting today. Thank you.
Jeffrey, thanks again.
Okay, thank you. I hope it was good and useful.